Honestly, like, I think for a theme, just staying diversified and hanging on is going to be the key for 2026 and frankly for every year. But let me talk about why specifically I think 2026.
Welcome back to another episode of Off the Wall. Markets are moving fast, and we're here to help you stay one step ahead. Well, hopefully that is. I'm Nate Tonsager, and as always, I'm joined by Monument's co-founder and CEO, Dave Armstrong. Dave, I know you're a college football
Hello,
fan. It's
everybody. Yep.
college football playoff time. One game tonight on the 8th here, another game tomorrow, and we're down to the final four. So before we get into what happened in the markets, I need the most important prediction you're going to make today. Who is the national champion in college football this year?
That's a great question because I don't know. There's no facts about the future, right? But let me just talk about, real quick who I like. Okay. So I'm an SEC fan. I'm a Gamecock fan. So my rule is I always pull for the SEC team. So now I'm pulling for the Ole Miss Rebels. I am also pulling for them because I feel like they were so slighted during this coaching change thing that they're almost like the Cinderella story, right? They're the team that just lost their coach with a big, public brouhaha over it. And so you've got these poor players who just want to go out there and win. So I'm kind of rooting for them. But also I kind of like the Miami Hurricanes because I don't know, they're a big history team.
Yeah.
It's great to see them coming back. And then flat out, I'm pulling for Indiana over Oregon. So my point is this. If Ole Miss wins, I'm pulling for Ole Miss for the rest of the time. If Miami wins, I'm pulling for Indiana to win it. So I love this Indiana story. I just think it's great. So, and I just saw that Mark Cuban's given them a whole lot more money this year. So they're probably going to be
I think
somebody to contend with for a long time.
money changes everything. So the NIL era has changed it because I'm a University of Wisconsin-Madison graduate. So I'm Big Ten all the way through and through, and they stink. So I'm going to go with Indiana. And to your point, it's because they're the Cinderella story, and I love their
Yeah.
coach. I think the favorite thing, right, is he shows up and he goes, I win. Google me, I think was his famous quote. So I kind of like the confidence. I like it all.
Right. So I guess another way to say it is I'm rooting for everybody except Oregon. So
Fair enough, right?
there's my prediction and enough on college football because I know everybody wants to know what we think about the market. So we should probably just jump right in there, right?
Yeah, I think that's what people are here for, right? It's off the
Right.
wall. It's markets time.
So just for context, I mean, we are here to talk about our quarterly market recap, and what we're keeping our eye on as we look into the future. This personally is one of my favorite episodes. I think it's our favorite episode because we talk about the fourth quarter. We also look back on the entirety of 2025 and then we dive into 2026. You see the metrics of how much it's downloaded. This episode is always very popular with everybody who listens. So I'm excited about this. But before that, let's kick this off, Nate, by just talking about some general, how did the markets perform and some of the winners of 2025. And then we can kind of jump into 2026. So I will start it off with this. It's a pop quiz that you don't have to answer. Okay. But pop quiz. What were the best in performing global ETFs? So think country ETFs, right? Not EEM or not emerging markets or the EFA index. I'm talking about the actual country ETFs. There's 68 of them total. The best performer, pop quiz, was South Korea, ticker EWY, up 94.4% for 2025. I mean, this is about 100. Who on CNBC at all over 365 days said the word South Korea ETF EWY? I never heard it. Maybe it happened, but it certainly wasn't a very common conversation to be talking about the outperformance of the South Korea ETF at 100%, essentially. I'm rounding up, right?
Sure.
Okay, if there's compliance people out there, I'm disclosing that I'm rounding up from 94.4 to 100% because it's pretty darn close. But, and then, okay, so let me give that some context, right? And Nate, I know you're going to have some interesting stuff on this too, but let me just rattle here for a second. The All World ex-US ETF, and the ticker of that is ACWX, by comparison, was up 32.6%. Great return, right? But nowhere near 94.4 slash Dave Armstrong's rounding it up to 100. Okay. I mean, so there's some context. Here's some more context. The total world index, and I like to use VT Victor Tango as the ETF ticker there, up 22.4%. So the total world includes the US. So obviously the US drug it down. And then the US, most people know this, but for context on the podcast, the S&P 5, there's some total returns of it. I'm just calling it 17.7% up year
Yeah.
to date for 2025. 17.7. So you can see the US actually drug the total world down from the all world ex-US. So really interesting. Now, worst country ETF for 2025 was Saudi Arabia. Ticker KSA was down 8.2% for 2025. And frankly, or interestingly, it was one of only two negative country ETFs for the year. The other one was Turkey, or as I am told they would like us to repronounce the country as Turkiya. Ticker TUR was down 1.5%. So all the other countries were up. All the 66 remaining ETFs were up. So pretty interesting way to look at last year's market without just talking about just the S&P 500. So the important part of 2025 for me, for this review, is addressing the often asked question of, well, geez, why don't I just own the S&P 500? Well, there you go. This is why you don't just own the S&P 500, right? You've got European stocks, and I'm going to use the MSCI Europe Total Return Index. It's not an ETF, okay? Was up 36.3% for 2025. So think developed countries, European stocks, right? Then you have emerging stocks. I'm going to measure that by the MSCI Emerging Market Total Return Index again, up 34.4%. So 36.3, 34.4 for developed and emerging markets. And then the S&P 500 was up again 17.7. So Europe was 2.05 times the return of the S&P 500, and the emerging markets was 1.94 times the return of the S&P 500. So that kind of answers the question of, why don't I just own the S&P 500 and forget about it? That's a pretty good reason right there. Now, for the past many, many years, that hasn't been the case, but last year it was, and I'm just pointing it out. So also, interestingly, for 2025, the S&P 500 had a maximum drawdown, right, peak to trough, of 18.9%. So Dave Armstrong rounding, in effect, I'm calling it 19%, right, down 19%. And a year-end return of, again, 17.7. So that's essentially a 37% rally. And along the way of being down 18.9% and then an ultimate year-end return of 17.7%, the S&P 500 hit 39 all-time highs along the way. Now, if you compare that max drawdown to the year-end return, if you compare that to 2022 had a swing of minus 25.4% and a year-end return of minus 18%, right? So big swing to the downside, it didn't recover. And then in 2020, which was COVID essentially, you had a swing of down 33.9, this is called 34%, and then a final year-end return of 18.4%. So last year, it was as much of a swing and as much volatility as 2020 COVID year had. Well, pretty close to it, right? That was the next biggest one. But I just think it's important to remember that 2025 for the year was the fourth worst start to a year for the S&P 500 ever. So only three worse years than 2025 for the start. So a lot of volatility in 2025 to get to that 17.7% return. And there had to be a lot of discipline in there. And I think that kind of just makes the case for what we tell people all the time, which is, look, if you don't need liquidity, sometimes the best thing to do is leave stuff alone. But Nate, I know you've got some other 2025 interesting tidbits and thoughts, surprises.
Yeah, I think to kind of unpack what you were talking about there, it did feel like a very volatile year last year. Like you mentioned, with those big swings down to end the year so positive. But when you look at it in historical context, that was average volatility. And that's the thing
Mm-hmm.
is, while it feels in the moment, people like to always say, well, this time is different. And that is the most dangerous phrase maybe of investing, because when you look at it, it was just normal volatility. And if you stayed the course, you ended up in a pretty good place, which I don't want to pretend like that's easy. That's the other thing too, is when we hear clients say, why don't I just own the S&P 500? That's not a horrible idea sometimes. Sometimes all you need is to keep up with the market and not drastically underperform. But that's not that easy when the market goes down 18%, because that means you're going down 18% with it. And in
Mhm.
years where international stocks like what we just saw do really well, you kind of missed out on some of that performance. Now, so that's the thing is you can invest like the S&P 500, but if you're going to do that, you still have to stick to the plan over the long term. And a lot of the data shows that's more difficult than people think. Morningstar does a study every year that looks at just US equity large cap funds. So think S&P 500 like funds. On average, what they're trying to do is measure the effects that investors incurred on themselves by getting in and out of the market, making emotional decisions. And over a 10-year period, investors are losing about 0.6% per year
Mhm.
from just mistiming the market. If they had just stayed invested, they'd be 0.6% better. So, yes, even some clients we have that I think we invest their portfolios much like the S&P 500 or whatever market cap index, whether it's global or dividend focused, we do that for clients. But where we can still add value maybe isn't necessarily beating the index by 3, 5%. It's by helping them stay invested and making sure they're not giving up 0.6% a year. And if you're going to do that, you can use ETFs, but there's other solutions too, like what we talk about with direct indexing, which different story for a different day. Check out our website. We have great articles on that. We can put the link in the show notes, but buying and holding an ETF, isn't easy. And there's better ways to get market exposure that are more tax efficient. So
Mhm.
that's kind of my like broad themes of 2025 is you didn't necessarily need to beat the market, but you needed to stay with the market throughout the whole year.
Yeah.
So it sounds easy, but it's really not. I wish it was as easy. It would make my life a lot better if everyone could stick to a plan, but I get it. It's emotional. Money is emotional. So,
Right.
all right. Well, we've pontificated too much on the high level stuff. Let's maybe get into some of the nitty gritty of
Yeah,
2025.
sure.
So, Dave, you kind of brought up some of the performance figures, but what did you think was the most surprising or even most interesting thing of 2025 when it came to the markets?
Okay, I've got a couple of interesting things about 2025, so everybody just strap in and listen up. Here we go. I've got a lot. So, one of them was no recession in 2025. So, in January of 2026, with actually a pretty good start to the year so far, people are probably like, "What do you mean? Like, big deal there was no recession in 2025." Okay, it was a huge deal that we didn't have a recession in 2025. And I think what not that I was calling for a recession, but I think the thing that surprised me the most about it was back in April of 2025, the implied chance of a recession hit almost 70%, right? So people kind of forgot about April and everybody 70% implied chance of a recession happening. And this was all tariff based, but like people kind of
Mhm.
forgot about that by the time December rolled around when it was essentially zero implied chance of recession because it was December at the end of the year. But still, it didn't happen. So to me, that was a surprise that it got high and then didn't happen. In the face of high inflation, high mortgage rates, high Fed funds rates, the tariffs, none of those things derailed the economy when the implied chance was 70%. So that was a surprise, I think.
Yeah, you kind of stole my, I think, biggest surprise too. Is there was so
Sorry,
many.
man.
No, it's all right. I mean, hey, I think it's most people's. If I'm being honest, I think the biggest surprise is there was a lot of negativity, especially on the back of Liberation Day, which came in April,
Mhm.
where out of nowhere tariffs went from essentially zero to worldwide at least 10%. And I think what that did is markets don't like uncertainty and big changes that happen quickly. And that's what that was. Is it became emotional. It became, very much the world is going to end. To your point, recession odds spiked. But they came down quite quickly once tariffs were delayed, which gave investors and businesses time to start planning and reacting to what the new regime was going to be. But also, the new regime shouldn't have been a surprise. I think ever since November, when the election day actually happened, you could see a world where tariffs were going to be back on the table and happen very quickly. So it's kind of strange to say, my biggest surprise is we didn't have a recession. And I think that's almost a little pessimistic, but at the same time, too, the Fed took a while to start cutting rates. People thought rates would be coming down much quicker than they did,
Yeah.
and well, I think that's another factor too that you just can't escape was the market was just resilient and earnings were good. It wasn't like this was irrational
Yeah.
exuberance kind of markets. The earnings were there, especially in the big companies, to support the market.
Yeah, I agree. Okay, here was another surprise, and I've already said it, but international equities finally outperformed. It's been a long time in the waiting there, but the performance of some other asset classes caught my attention. So I want to dust off and resurface the debate over the 60-40 portfolio because in 2022, there was a lot of common opinion and pontificating on financial media, and people were writing about this a lot, not inappropriately because it was a thing, but,
Mhm.
there was the opinion that the 60-40 stock portfolio was dead, that, it wasn't gonna do well anymore, and when I say the 60-40 portfolio, I'm specifically referring to 60% invested in just the S&P 500 index fund, and then 40% in the Bloomberg Ag Index, or for the old salts out there, remember the Lehman Ag Index. And people were saying that that combination of those 2 things was dead because the return was minus 16% for the year in 2022. Okay, now let's hit the tape. For the next 3 years, the total return for that portfolio, 18%, plus 18%, plus 15.5%, and plus 13.6% in 2025. So it I'm just surprised that with all of the people saying that the 60-40 portfolio is dead based on its return performance in 2022, that we had, you know, mid to high between 13 and 19% total
Yeah.
returns for the next 3 years. So that was a surprise. And then, in that, on top of the 60-40 portfolio, another surprise for me in terms of just asset classes that caught my attention was REITs being the worst performing asset class at a positive 2.3, so it wasn't negative, but that was a surprise to me because like you're saying in with the interest rates changing the way they did, I I thought REITs would have done better last year. So I don't know what you think about that.
Eh, yeah, REITs struggling it's just weird for me. I don't understand why 2025 wasn't their year. I think you kinda hit the big reason I would have thought REITs would have done well is interest rates came down. And it's not, a one for one. Interest rates aren't the only thing that matter to real estate
Mhm.
investing, but they're very supportive to making real estate a stronger asset class if you have rates coming down, and rates did. Sure,
Yeah.
as we kinda said, they didn't happen as quickly maybe as people thought, but at the beginning of the year, people thought we were only going to get 2 rate cuts. Well, we ended up with 3. We ended up with more rate cuts than people expected at the start of the year. So I just don't get it. Like, why did they stink? Is this a housing has been so tight and people now are overbuilding apartment complexes and there's too much supply of apartments? Or is it the fact that remote work and hybrid work is still sticking around and office buildings have vacancies? It doesn't seem like those are I think those are elevated, but not to the point where it should be such a bad performing asset class. I don't know. I sometimes the market just confuses you and you can't really explain what happened. It just is a demand story maybe.
Right. Well, maybe 2026 will be their year and they'll just play a little catch up. Maybe they're just lagging. Who knows? We'll see what
Yeah,
happens.
it is. It's hard to know. Well, I mean,
Yeah.
my biggest surprise, I think, too, I know we talked about with the no recession, but of performance purposes, and when you look at what was a top performer, you mentioned the country ETFs. Well, I got something that did better than South Korea at its
Yeah.
near 100. It
I
was
know what you're
silver.
gonna say.
Yeah.
I knew you were gonna talk about it. You're like the gold and silver lover. Yeah.
Yeah. Oh, yeah. No, I have a stash buried in my backyard that I'm just sitting on. But I mean,
Right.
it's super interesting because for a long time, gold is, again, we've talked about it on previous podcasts, and silver, all these precious metals are commodities based on supply and demand. And this year,
Mhm.
there was demand for it, and a lot of it. I think when you look at it, gold and silver had one of their best years ever and the best year since 1979. So almost 50 years we haven't seen performance like this, where gold in 2025 is up 64%. When you look at an ETF ticker IAU, the iShares Gold Trust, and the silver ETF was up 144%. Way better than
Yeah.
that 100% that you saw, Dave rounding errors, but 100% you saw in
Mhm.
that South Korea ETF. And again, it's makes a lot of sense if you think about it because gold does trend when people are scared about inflation. Interest rates are coming down and there's geopolitical uncertainty. We had all three. Now, I think what really surprised me is the extent that it ran. Like I could have seen it having a good year, maybe, just being a top asset class, but to gold be up 60 and then silver be up 140, 150%, that's stuff that you
Yeah.
just can't predict. And if you were invested in at the beginning of your year, great. It still could be a good time to invest now, but just know that those are volatile assets, which is why you see big up moves. You're probably able to see a big down move too. And so my recommendation with that is if you do actually have gold buried in your backyard or silverware, old school silverware you've inherited that you're not attached to, don't be afraid to see what it's worth.
Yeah.
Maybe you can squeak out some extra value, but we heard a great story recently about a retired dentist cleaning out his basement, came across old gold fillings that didn't need, never used, bought them decades ago. Well, he took a chance and an opportunity to capitalize on this kind of market and made some money that I don't think he was expecting. So it's almost like a little lottery ticket in his mind, because I think to see consecutive years of strong performance, that's going to be very tough, even though we may still see some geopolitical uncertainty in 2026. Interest rates
Yeah.
still could continue to come down. Inflation, I'm a little more torn on, but still, two of those three supporting gold. It's not like I can see a world where I think gold goes to zero. Let me put it that way. So, Dave, I know you had one last thing I think that came up when we were talking, pre podcast that you wanted to bring up about a surprise. So the floor is yours.
Yeah, this is a little wonky, so it's possible if you're watching this, you may tune out, or if you're driving, you may drift off the side of the road, but try to stay awake with me on this because I'll get to explaining it, but it is a little wonky. If you break out the stocks in the S&P 500 into deciles, right, into 10 slots, let's say, based on where the securities were above or below their 200-day moving average at the beginning of 2025, okay? And then so you made 10 shoots with those stocks and you put those in there. And then you look at the total return for those 10 different deciles or shoots of stocks, from best to worst. So they're the first decile and the 10th decile, the shoots at the very end when you line them up based on where they were on their 200 above or below their 200-day moving average. The first and the 10th decile, the very ends, were the two best performing groups of stocks. Okay, so if you tuned out or if you drifted off the side of the road, come back in now. I'm going to tell you what that means. Basically, this means that the stocks that were already doing well at the end of 2024 did well in 2025. And then the dog shit stocks at the end of 2024 did really, really well in 2025. That's it. Everything else in the middle was just sort of like meh, you know? So that was a little wonky, but that was a surprise to me that it was those two shoots of deciles that did the best. The crappy stocks at the end of 2024 and the ones that were doing already really, really well at the end of 2024 did well in 2025. I thought that was kind of interesting.
I think, yeah, you heard it all the time about, it's a narrow market, meaning only a handful of names are doing well. And that data
Mhm.
really shows it. And it's not just maybe the Mag 7 names, without looking at the decile breakout, but you really saw like your average company didn't really have a great year. You really kind of either had to be on those tail ends of kind of where people thought you were heading into the year. And again, it just means the market's going to be impossible to predict. Because if you would have told me that not only are the best stocks going to continue to be the best, but the worst stocks are going to be the best, I'd be like, okay, that sounds like we're making a prediction to get clicks. But realistically, that's what happens over short times in the market. And a year is a short time. I think that's always important to keep in mind too.
Yeah, right. Like if you think about that movie, Meet the Parents, and Robert De Niro says to Ben Stiller, like, "How's your portfolio, Greg?" And he says, "Strong to very strong." If you said, "Well, I've got a portfolio of really good stocks," there's a chance that you didn't do that well last year because your really good stocks are in deciles 2 through 9 and just were
Yeah.
sort of meh, you know? So if you said, "Oh, hey, how's your portfolio, Greg?" And you said, "Full of dog shit stocks," then you probably did you probably did okay in 2025. That and throw in some
Yeah.
mags, but, or some of the stuff that was doing really well at the end of 2024. Anyway, I just thought that was kinda interesting that it was so both the opposite ends of the spectrum were the ones that outperformed based on where things sat on their 200-day moving average at the end of 2024.
Yeah. Well, and now
So,
we don't just want to dwell on the past. Like it is, we got to
yeah.
look forward to into the future. So enough about 2025. Let's think about 2026. So I think kind of the question that I am not struggling with, but trying to maybe get the best handle on I can as we kick off the new year is, what do we think are going to be the major market themes? So maybe not necessarily a prediction specifically, but what do we see kind of driving the market or being talked about in the market going forward?
Yeah, this is what I think, and this is gonna be a barn burner of a statement. This statement's gonna go viral. I know it, 'cause it's so unique. But look, staying diversified and hanging on is probably the key for 2026. And I just know that sounds so boring, right? Like, I nobody remembers you saying the boring stuff, right? And nobody
Hmm.
remembers you making a prediction and then being wrong at the end of the year. But I honestly, like, I think for a theme, just staying diversified and hanging on is gonna be the key for 2026, and frankly, for every year. But let me talk about why specifically I think 2026 could really require staying diversified and some patience, parens, that means hanging on, is because people know that basically, Dave Armstrong rounding here, that the average S&P 500 total return every year, the average return is 10%. The problem
Hmm.
with that is the stock market has only performed within 2% of that number in 4 of the last 98 years, right? So the average, you can spit out the average, but you rarely see a return. In fact, 4 of only
That is
98 of past years have you seen a return around 10%. And and the highest annual return over that period was 53% and the lowest was 44%. So it just look, and if you just look at you're like, great, 98 years, it's a long time. Okay, if you just look at the returns post 2000, right? So for the past 25 years, the highest annual return was plus 32% and the lowest return was a minus 37%. So there's a lot of banging around in that 10% number that people like to quote a lot. And I just think that there's a very high probability that there's going to be some volatility inside of this year just based on that alone, right? But here's another reason why I think the theme for the market is going to be hang on this year is because statistically midterm election years tend to have a lot of volatility in them, right? I always like to say when people say, "Oh, gee, there sure is a lot of volatility," my response is like, "Yeah, it's like saying like, gee, there sure is a lot of gravity today." I mean, it's just like it's part of living. But you got to remember that in a mid-election year, the average peak to trough decline during a midterm year is a 17.5% drop from high to low, peak to drop. That's kind of like what we experienced, very close to what we experienced last year with the April decline, right? So, and the median there is 16.6. So pretty close. Like that is some lump in the throat drops that have historically happened in a midterm year. Okay. Now, on average, the middle of that drop tends to take place in August. So
Hmm.
August tends to be the date when you hit the bottom of a mid-year trough, okay? The good news is, this goes back to the hanging on. The good news is that 1 year later, the average return on the S&P 500 is a positive 31.7%, right? So, theme, right? This is gonna be a huge shocker, but figure out how much cash you need and try to have it raised before August, when
Hmm.
there is a statistical likelihood that we will see some sort of a drop in the market based on what we've seen in the past. If you use history as a guide, um, because if you don't have to liquidate securities in the middle of that volatility, you're looking at an average return after that of 31.7%. Just, I'm not saying it's going to happen, but that's, if you're using history as a guide, those are the statistics. So, and I think statistics are more meaningful than guessing. So,
Well, and that gets back to kind of what I was talking about here around those staying invested versus timing decisions and the drag and the returns that you can have. Like, if your point, volatility is gravity. Volatility is the price you pay to be a long term investor. Don't pay a higher
right.
price than you need to. Don't pay a higher price than you need to by trying to time volatility. Instead, have a plan to ride through it. And we said this, I think, at the start of 2024. after the market's S&P 500 was up over 25% in 2023. And started 2025, we said, raise cash now. We just had back-to-back years where the market was up 25%. Now we have a year
Mm-hmm.
on the back of those two strong years where another year of double-digit strong returns above that 10% return of 17%. Like, if you didn't listen to us the past 2 years with raising cash, I'd do it now. You have
Yeah.
3 strong years of returns and an opportunity to really get in front of the volatility we know is inevitable.
Right. Or said differently, maybe you did listen to us and you raised the cash because you were going to spend it, and you spent it and you don't have any cash, not because you didn't raise cash, because you spent it. Right. Like,
Yeah.
I'm telling you, look at my American Express bill. I'm spending the cash I raised, so, uh, yeah, that's an inside joke because I had a big plumbing problem over Christmas, but we're not going to get into that on this pod. So, yeah, it could be either of those things, but you're right, especially
Yeah.
on the heels of 3 pretty good years since that trough of 2022. We've seen tremendous compounded returns over those years, and if you think you need cash, like, I don't think you'll ever kick yourself in the ass for raising cash right now.
I'll turn on my, let's say, TikTok camera for my viral moment here. But, I think my theme is rates are coming down. And how much and how quickly is yet to be seen, but they are going to be coming down. And I think the market is saying that it's going to happen 2 times. I think the data is saying they're wrong, the market expectations. I think we're going to probably see more than that throughout the year. So everyone knows the 2 mandates of the Fed is strong labor market, manageable inflation. Well, the labor market is softening. It's not collapsing, but when you look at data, whether it's hirings, whether it's planned firings, whether it's job openings, all of it is kind of pointing towards a weaker market, which means the Fed's going to have to support it and lower interest rates.
Mhm.
Now they have to balance that against stable inflation. And guess what? 2025 had all the makings of inflation coming roaring back, especially because of tariffs. That didn't happen. When you look at the personal consumption index, the PCE, the one the Fed looks at, it ended 2025 at about 2.8%, unchanged from the beginning of the year. So you had tariffs and global uncertainty and all this going up while inflation did not budge. And right now, I think even we could find this out as soon as tomorrow, but the Supreme Court is going to be ruling on, are the current tariffs legal, quote unquote.
Right.
Even if they say that they are illegal and all the tariffs that are currently in effect get wiped out, the Trump administration and White House already has a plan laid out in writing that everyone knows about, that of tariffs will be coming back, probably at a lower rate than they are right now. But that's not a bad thing. So tariffs aren't going to go away, most likely, even if the Supreme Court rules that they are, quote unquote, illegal. They're just going to come in at a lower rate. So you're going to have a lower tariff rate that's supportive to lower inflation. That doesn't say inflation's coming roaring back. So you're going to have managed inflation with a weakening labor market that the Fed wants to support. And I think a lot was also made in 2025 about the Fed's independence. Well, Chairman Powell terms up is in May. So there will be a new Fed chair by mid-year.
Right.
And I think they will remain independent, but that doesn't mean whoever becomes the new chairman is probably going to be, or maybe have the belief that rates should be lower. I think the data supports it though. So even if they come in and start lowering rates, that's not because of a personal bias or vendetta or any reason. It's really because the data is supporting it. And yeah, there probably is a little bit of a bias there, but that's not a bad thing to want to be supportive to a financial market where the data supports it. So 3 big reasons interest rates are going to be lower a year from now than I think what people are expecting.
Yeah, I'll tell you, and just to punctuate your point about employment, right? The US added an average of 20,000 private sector jobs per month over the last 3 months of 2025, according to the ADP data, right? So now, great. It's not great. But that was 90% lower than the last 3 months of 2024, where we were seeing 20,000 jobs a month, right? And there are now 685,000 more unemployed people than there are job openings in the US. So excluding the 2020 COVID recession, it's the widest spread we've seen since 2017. I mean, the labor market is continuing to cool, which adds credence to your prediction that interest rates could come down more than what the market is expecting. Nate, I agree with you on that. Okay, Nate, well, that kind of wraps things up. To the listeners, I mean, hey, if you've made it this far in the episode, thank you so much. But as a reminder, we run these Ask Me Anything or Ask Monument Anything, we like to call it, once a month where we get questions in and stuff like that. So I do want to, even though this wasn't an AMA segment, I do want to remind everybody that you can submit a question to us anytime by emailing offthewall@monumentwm.com. So off the wall, all one word, at monumentwm.com if you want to ask us a question, and we'll answer it in our next AMA segment.
Yeah, or leave us a comment. We've had questions come in from
Yeah.
YouTube comments, from any kind of the platforms. Like, we're tracking all of it. And, I think Dave and I, as you know, we could talk for days about any market topic, but we're kind of always interested in what is top of mind for people. So, and at the same time, too, I think it's important just to make sure that we always call out. We have a sister podcast between SIPs, hosted by, Monument's partners, Jessica and Emily. While we talk investments, they're really focused on, coffee table conversations that people are having on how to kind of turn their wealth into options. And that really comes down to financial planning, gifting, you name it, more of kind of those topics they always talk about there. So subscribe to both. That way, every episode, whether it's between sips, off the wall, top of the feed, wherever you get your podcast, wherever you watch us. So, I think it's important because we always say money without meaning will never feel like wealth. You need planning, you need investments, you need it all to really kind of get there over time.
Right. All right. Well, that's a great way to wrap it up. So we'll see everybody on our next episode of Off the Wall. And again, if you have any questions on this segment, anything that we talked about, or anything from whatever, drop us a comment. LinkedIn's a good place too, right, Nate? We get a lot of questions on LinkedIn too. So, okay, with that, I'll say goodbye to everybody.
The previous presentation by Monument Capital Management LLC was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Monument or any other investment professional of your choosing. Different types of investments involve varying degrees of risk. It should not be assumed that the future performance of any specific investment or investment strategy or any non-investment related planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Monument's investment advisor registration status, nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Monument is engaged or continues to be engaged to provide investment advice services. Monument is neither a law firm nor an accounting firm. No portion of its services should be construed as legal or accounting advice. No portion of the video content will be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Monument is engaged or continues to be engaged to provide investment advisory services. A copy of Monument's current written disclosure brochure discussing our advisory services and fees is available upon request at www.monumentwealthmanagement.com.